The last video presented an overview of the individual income tax calculation. In this video, T14C, we start to tear apart some of the sections and look at the details. This one covers the all-important standard and itemized deductions. These were the subject of substantial news coverage during the most recent tax reform, and we're going to cover both the old and the new rules. Okay, before we get started on this fairly long video, let's remind ourselves of the overview computation. In this particular video, we're focused on step 3. So here's the section of Form 1040 where these deductions are reported. So let's take a good hard look at line 40. So first, either the standard deduction or itemized deductions are reported here. And the line itself provides an audit trail. If the taxpayer itemizes, the amount's supposed to come from Schedule A. If they're using the standard deduction, then the amounts are actually provided in the left-hand margin in the little bubble. So recall that the greater of the two amounts is the one that you are eligible to deduct. Okay, so this table presents the standard deduction amounts over the past few years. So notice there's a different standard deduction by filing status. And notice that, of course, they've changed over time due to inflation. And then there's a fairly large difference between 2017 and 2018. And as I believe I've mentioned previously, the tax law passed in late 2017 nearly doubled the standard deduction amount. So this is in part an offset for the repeal of the personal exemption deductions, which are discussed in the next video. So as it turns out, the standard deduction is not as standard as you might think. Consider ability to pay when we think about these two taxpayers. Jane is young and single and has income of $80,000. Julie is also single but has reached retirement age and is blind. To try and align the standard deduction with ability to pay, the law permits those over 65 or over and those that are blind an additional standard deduction amount on top of the typical standard deduction. So blind, I basically get that. But generalizing those over 65 with the ability to pay kind of just ignores the notion of ability to pay. It might have been easier to measure AGI to provide an additional benefit, but let's face it, retired folks vote. Reducing the standard part of the standard deduction even more is that those that can be claimed as a dependent by another taxpayer are entitled to only a reduced standard deduction. Currently, that amount is $1,050. However, for dependents that generate earned income, that's income from working, they can take their earned income plus $350 as a standard deduction, but never more than the single standard deduction amount. So by tax law, the tax law, by increasing the standard deduction amount, provides a much bigger opportunity for a working child still claimed as a dependent to shelter a big chunk of income. Right, so under the 2018 rules, that's up to $12,000. So consider, again, my sister, the dentist. Assuming she could justify the wages paid to her daughter, she can now pay her up to $12,000 and shift the income to tax exempt. Wow, we just spent 4 slides on the standard deduction. And that's supposed to be standard? Now we're going to turn our attention to itemized deductions, which, as previously mentioned, are a selection of personal expenses that are permitted as deductions from AGI. Itemized deductions are reported on Schedule A. Each section of Schedule A is used for each of the itemized deductions. The itemized expenses in Schedule A order are medical expenses, taxes, interest, charitable deductions, casualty losses, and miscellaneous expenses. Of these, medical expenses, charitable deductions, casualty losses, and miscellaneous deductions are all subject to percent of AGI floors. Interest is limited to a certain amount of mortgage debt. Of course, much of this changed with the new tax law. Currently, medical, charitable contributions, and casualty losses remain limited by an AGI floor. Taxes are now limited to a total deduction of no more than $10,000. The mortgage limit dropped from $1 million of debt to $750,000, and a deduction for miscellaneous expenses is no longer permitted. All right, let's cover each of these in a bit more detail. Medical expenses represent expenses incurred that are not reimbursed by insurance. The floor was 10%, but starting in 2018, decreases to 7.5%, which is actually favorable. Let's use the 10% floor, because it's easy math, to provide an example of how these floors work. Barb's AGI is $50,000, and her medical expenses total $5,500 during the year. Using a 10% of AGI floor, Barb may only deduct $500, which is the $5,500 of expenses less 10% of $50,000. The 7.5% floor would result in $5,500 less $50,000 times only 7.5%. If medical expenses are below the floor, no deduction is permitted. For example, if Barb has incurred only $2,000 of expenses, under either the 7.5% or 10% floors, she would not be eligible for any deduction, as $2,000 is less than 10 or 7.5% of $50,000. State and local taxes, such as property taxes or state income taxes, are deductible as an itemized deduction also. For states with no income tax, the tax law permits a deduction for sales taxes instead. That is, a taxpayer can choose between either state and local income taxes or sales taxes, but not both. Property taxes, on the other hand, can be added regardless of the income versus sales tax choice. Prior to 2018, taxes were effectively unlimited. However, the new tax law limits the total deduction for all of those personal taxes to only $10,000. Personal interest is generally not deductible. However, mortgage interest on a personal residence can be deducted. The debt limit was $1 million and is now $750,000. This means that for mortgages over $1 million, at least under the old law, interest on only the portion up to $1 million would be deductible. Now that limit for mortgages entered into after 2017 is $750,000. However, mortgages already in existence prior to the change in the tax law can still use the $1 million limit. Interest on home equity loans up to $100,000 was also deductible up through 2017. The new law permits a deduction for home equity interest only in limited circumstances. Lastly, on interest. The law actually permits the deduction of mortgage interest on two homes, a primary residence and a second home, and each residence has its own $1 million or $750,000 limit. The tax code permits a deduction for charitable contributions also. These must be made to qualified organizations and are generally limited to 50% of AGI. Starting in 2018, cash contributions are limited to 60% of AGI. Charitable contributions of property offer a unique opportunity to take a deduction and at the same time avoid taxes on a gain. For example, Janelle owns stock that she purchased for $10, but it is now worth $100. If she sells the stock, she pays tax of $13.50, which is the 100 minus 10 or a $90 gain times 15% long-term capital gain rates. She would end up with $86.50 after tax, and she then could contribute the cash. Alternatively, she could just contribute the stock itself. The rules permit a deduction for the market value of the stock, so instead of an $86 deduction, Janelle gets a $100 deduction and never has to pay tax on the gain. We've already discussed casualty losses, so the only item worth mentioning is that deductible losses are now restricted to losses associated with an event that is declared a federal disaster. Since the miscellaneous expense deduction has been repealed, I'm not even going to spend any more time on it. In order to prevent high-income earners from sheltering a significant amount of income through itemized deductions, the tax law previously included a phase-out of itemized deductions for high-income earners. That provision was also repealed. So, what kind of taxpayers itemize? When the standard deduction was about $13,000, just about any homeowner with a mortgage itemized. Mortgage interest and property taxes alone were often enough to eclipse the $13,000 amount. However, now the increased standard deduction of $12,000 for single and $24,000 for married filing jointly requires a much greater level of mortgage debt or property taxes associated with a more expensive home. For high tax states like California or New York, the cap on state and local taxes of $10,000 is likely to limit itemizers. Because itemized deductions are considered a tax expenditure, which we discussed in Module 1, the Joint Committee on Taxation provides data on which taxpayers are using itemized deductions. You can see that very few low-income taxpayers itemize. About 6% of taxpayers with income of $50,000 or below itemize. 32% of taxpayers with income between $50,000 and $100,000 itemize, and 70% of taxpayers with income over $100,000 itemize. It should come as no surprise that the mortgage interest deduction follows a similar pattern and is largely used by higher income taxpayers. Same with taxes and the charitable contributions. So, what planning can be done with respect to itemized deductions? Well, one strategy is to try and bundle deductions into a certain year. For example, taxpayers rushing to pay 2018 property taxes in 2017 to avoid the $10,000 cap made quite a bit of news in December 2017. However, more generally, the opportunity to bundle charitable contributions to within a single year might provide just enough deduction to clear the standard deduction and provide that extra itemized deduction that year. Many of the changes to itemized deductions expire in 2025. After that year, most return to the 2017 rules. Whew, that was a toughie. This brings us to the end of our discussion on itemized and standard deductions. We turn to the exemptions next, so it should be short since they're currently revealed. Thanks for watching.